So today we are looking at constructing a balance sheet, and we'll be working from this booklet, SACE 2 Accounting Part A, the balance sheet, and in particular we will be looking at exercise 16 on page 35, and here it is. I've already written up here the accounting equation. There it is, assets equals liabilities plus equity. And I've also put the alternative form in there, equity equals assets minus liabilities, which is our net assets, just for my and your benefit. So we want to use this worksheet to post the transactions to the ledger accounts. These are ledger accounts. These are those ledger accounts with a couple more. And here are some opening balances, Sam's opening balances. For the cash, 3,000, debtors cash 8,000, debtors 3,000, motor vehicles 15,000, and creditors 2,500. Now the first thing we want to do here is classify our accounts, and so cash account is an asset, so let's put that in there. Debtors account is also an asset. Motor vehicles is also an asset. Now, I hear you say, but cash and debtors are current assets and motor vehicles are non-current assets. And you're absolutely correct. Good call, good classification of those accounts. But at the moment, regarding the accounting equation, I'm only interested in whether it's an asset, a liability, or an equity. So I'm not interested right now whether it's a current or non-current asset or liability. So cash, debtors, and motor vehicles are all assets. Creditors are liabilities, not current, I hear you say. Well done. And our opening equity account, our opening capital account, of course, is an equity account. So here we are, we've classified these accounts. We have 3 asset accounts and 1 liability. So to calculate the capital account, we add up our assets, deduct our liabilities, and that will give us our opening capital. Here we are. 3 plus 8 is 11, plus 15 is 26. Put that in there, 26. Nice and big because it works well. Minus, in fact, I'm going to do it like this. Let's put in a bracket, 2,500, because, in accounting, we write negative figures with brackets, just like that. There it is. So 26,000, which is our sum total of our assets, minus $2,500, our total creditors, our liabilities, equals $23,500. Excellent, there it is. So down here, I'm going to write in 23,500, nice and big, because it fits. There it is. Now, this table here, what I want you to do here is record these transactions, and this is a continuation of the transaction effect on page 34, where we looked at the duality concept and every transaction having at least 2 transactions. Okay, up till now we've only been looking at one side of transactions, but there are always 2 sides to every transaction. You can never have a single transaction in isolation. You can't buy something without someone selling something. Within a business, you can't affect one account with it also affecting another account. So let's have a look at this. On the 1st of June, Sam paid $1,000 to his creditors. So if he's paying that, money's going out. Let's put that in a bracket like this. I've got to put a negative there. That would have worked. I'm putting it in a bracket so that we get used to, in accounting terms, brackets, it means a negative figure. So cash balance is decreasing, and creditors are also decreasing. We did have a $2,500 balance, but we paid $1,000 off. So that's going to decrease by $1,000. There it is. On the 4th of June, Sam withdrew $500 out of the business. So his cash account will decrease by $500. And his drawings account will actually increase by $500. So what's going on here? Because drawings are an equity account, aren't they? Look, there it is. E for equity. So drawings are an equity, but this is going up and cash is going down. Is that not violating the equation, our accounting equation? Well, drawings have a negative effect on equity. The more you withdraw from your business, the less equity you have, less left in the business. So drawings is like a negative equity account. If drawings has a positive balance, we have to deduct that from our equity at the end of the day. So by having a positive balance in our drawings account, we are actually decreasing our equity. I'm going to leave that 500 there because this is an account balance. The drawings account has a positive balance of 500, and that negatively impacts the equity side of the equation. On the 10th of June, Sam received $2,000 from debtors. So he received money. There we are. Into the bank account it goes. And that was from debtors. So debtors owed Sam $3,000. That's a current asset. And those debtors paid off $2,000. So the debtors balance decreases by $2,000. There it is. And what we have going on there is one asset increasing and another asset decreasing, and we maintain the accounting equation. Now to calculate the closing balances, we just add up everything along each row. So cash starting opening balance was $8,000, minus $1,000 is $7,000, minus $500 is $6,500, add 2 is $8,500 closing balance. The debtors, our opening balance was $3,000 minus $2,000 which got paid off, so our closing balance now is $1,000. Motor vehicles, there was no change, so I'm going to put that like this here, still $15,000 because that's an historic cost, and we're not going to change that. Whoops, didn't want that. Here we are. I'm going to put $15,000 down there and then drag it up. There it is, so it's underneath. How I like it. Creditors, opening balance was $2,500 minus $1,000 that got paid, that we paid, so the closing balance is $1,500. There it is. And capital, the opening balance was $23,500 and we withdrew $500, so less $500. Our closing capital balance will be, oops, I'm going to do it like this, just so it's all neat and tidy underneath each other. Whoop, it's not 500, it's 23,000. Opening balance of 23,500, less 500 of drawings, gives us a closing capital account of $23,000. I've used the balances of these accounts. Now, we could have also added up our three assets here. Debtors and motor vehicles is 16 plus 8 is $24,500. $24,500, I might put that in there. 24,500 less 500, like that. Tidy that up a bit. Equals $23,000. I'm glad that worked out. Terrific. There it is, $24,500 worth of assets minus $1,500 worth of liabilities gives us $23,000 worth of equity, and everything balances. Fantastic. From here, what you can do is exercise 17. So we have opening balances again. We can calculate our opening capital. In the table here, we carry down these accounts, these ledger accounts, and there'll be another one or two that we may need to populate here. There's room for that. So for each, we've got 5 days worth of transactions. Put a day's worth of transactions in each column, calculate the closing balances, and then carry forward those closing balances to create the balance sheet, including the statement of changes in equity. We'll have opening capital. Looks like we've got a capital injection there. Then we'll have closing capital. Statement of changes in equity for the year ending, of course. Put in the date. Balance sheet as at. Put in the date. Our closing capital. Carry it down to here. And our equity is represented by current assets. Put those 3 in there. Put their balances in. Do a subtotal. Non-current assets. And put that in there and calculate total assets. That will need to go right here. There's no box for that, but you can do that. Enter our current liabilities, our total liabilities, deduct total liabilities from total assets to give us our net assets. And this figure right here should equal your equity figure here that we got from our closing capital there. If it does, we can be confident that we have done it correctly. And if it doesn't, we have to go back and examine it and see what we did wrong. Because once we've put in all our assets, deducted our liabilities, our net assets must equal our equity, which is our closing capital. That's how you know you've done things well. Good luck with that. All the best.